Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello, and welcome to LiveSquawk's Q3 earnings season preview on Tuesday, the 14th of October. Over the next 30 minutes, we'll be looking at what the experts have to say about the corporate outlook and how wider domestic and international dynamics might play into company execs' views and expectations for year-end and beyond. I'll be joined by regular expert Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. But before we get into it, a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. So today, unofficially kicked off earnings season with a number of tier one banks, as well as the likes of Johnson & Johnson reporting numbers. Of those, the US biggest bank, JPMorgan, reported numbers today. Their adjusted revenue came in at $47.12 billion. That was a beat versus $45.5 billion. In terms of the sector breakdown, equity sales and trading revenue came in at $3.33 billion. Again, another beat. FICC sales and trading revenue was 5.61 versus 5.3. Investment banking was at 2.69 versus 2.61 forecast. Net charge-offs were at 2.59 billion, roughly in line with forecast, and total deposits at 2.55 trillion, was slightly off from expected 2.58. Loans at 1.44 trillion, estimates were 1.42, and standardized CET1 ratio came in at 14.8, just down from 15.1 last. ROE was 11%, estimates were for 15.7%. And so we also had Wells Fargo, that was up some 2% plus at the start of play today after raising key profitability metrics, and also gave its first major update about the bank's next growth target after removal of regulatory restraints it had operated under for about 7 years. And with that, I want to bring in Christine. Hey, Christine, how are you?
Hi, I'm very well, Harry. How are you?
Very well, thank you. Very well indeed. Thank you for joining us on today's episode and helping us sort of get through what is Q3 earnings season. I just want to take something that you said initially. You've written this before about Q3. It says earnings season gets underway this week then with reports from major banks providing the first look at corporate performance. Technology sector is expected to be standout performer with over 20% projected earnings growth, driven by ongoing AI arms race. Sectors that rely on lower-end consumer spending are expected to see earnings decline as shoppers become more value conscious. Do you want to break down just that for us, really, in terms of what we can look forward to from this earnings season?
Yeah, absolutely. I think first thing to note is coming into this earnings season, optimism is very high. We're expecting S&P 500 earnings growth of 8%. And that number's actually increased throughout the quarter. So typically throughout a quarter, analysts will ratchet down estimates because companies usually give guidance that is quite conservative. And so for the first time since 2021, we actually saw estimates tick up. I think it was only 0.1%, but still it was the first time we'd seen it in 4 years, and it bucks this usual trend, like I said. Revenue growth expected to come in at about 6.3%. So both very healthy figures. If we do get that 8% year-over-year earnings growth, it would be the 9th straight quarter of earnings growth. And so we're heading into the season with high expectations. That's both a good thing, but it also means investors are going to be more discerning, right? The bar is higher, so companies are going to have to beat by more to really earn, investors' applause for the numbers that they report. But like you just read off some of the banking numbers we got this morning, and we're kicking off on a good note, right? And financials expected to be one of the leading sectors, along with, I see you put the tech number up there, 20% year-over-year growth for information technology. Financials are expected to grow about 13.5%, so not so far behind. And we'll see how that blended growth rate changes once you factor in the 4 big banks that reported today. So JPMorgan, Wells Fargo, Citigroup, and Goldman Sachs. They all beat on the top and the bottom line. So that overall figure will be lifted after today's numbers. Tomorrow we get Bank of America and Morgan Stanley. And you called out a couple of areas of strength, which things that we were expecting that have had momentum now for some time. Investment banking was one area that investment banking fees rose across the board. We're seeing, the door creak open a little bit on M&A and IPOs. M&A with, regulation being a little bit looser and everyone needing to have an AI strategy. We've seen more deals being made there. And not just deals, because actually I think the total number of deals that we tracked at Wall Street Horizon for Q3 was about 111.
Right.
Volume-wise, that's on par with the first half of the year, but it's nowhere near what we saw like in 2022 after the COVID-19 pandemic. But dollar level wise, I think the M&A activity in the U.S. topped 1 trillion. So there's more mega deals happening, and that's certainly showing a vote of confidence amongst deal making. And then IPOs, as we all know, we've been tracking the CoreWeaves and the Circle Internet, and after kind of waiting on the sidelines for so long, a lot of these names are going public, and they're doing so and having great success. And I think that begets more companies that are private to kind of think about going public. And so those are a couple areas that the banks touched on. You mentioned trading, both equity trading and fixed income, currency and commodity trading. Was good for most of the banks. I'm trying to think, was it Goldman Sachs? Yeah, Goldman Sachs, I think, was the only one that saw equities trading come in below expectations. But for most of the other banks, like JPMorgan saw record third quarter trading revenue of almost $9 billion. So we know that volatility that we saw throughout Q3 between interest rate uncertainty and inflation and geopolitical tensions creates a lot of opportunities for the trading desk. So those were a couple of strong areas. And again, it just kind of kicks us off on a good note. The commentary, though, I always think to listen to Jamie Dimon because he tends to be one of the more cautious bank CEOs. And that was true again this quarter. He expressed some caution about future economic challenges, including geopolitical trade uncertainties and inflation. He said that the tariff inflation isn't fully priced in yet, right? Like we haven't realized the full impact. And then, he gave this interview with the BBC the other, just a week ago.
I was going to mention that. Actually, that where he was cautious about where we're going with the equity markets at the moment and whether they're looking a little bit on the toppy side.
Yeah, and he said, I'm probably one of the more cautious CEOs out there. He said I think the quote was, if the markets are pricing in a 10% chance of a downturn in the short term, like next 6 months to 2 years, I'm at 30%. So he's always runs a little more cautious or cautiously optimistic in some cases, but we see him doubling down. They just JPMorgan just announced that 10-year initiative to invest 1.5 trillion into companies that are critical for U.S. success. Things like pharma and medicines, life-saving medicines, and critical minerals. That's obviously been in the news lately with rare earth minerals and energy systems. So everything that he feels is critical to the prosperity of the U.S., that he feels maybe is at stake here, he's doubling down there. So always interesting to hear his comments because he does run a little more tepid, and he's very transparent. Sometimes you get vague commentary from these CEOs, and he sort of lays it all out.
Well, one of the quotes he did say this BBC interview said, "I'm far more worried about than the others." And said there is a higher risk of a serious fall in US stocks than there is currently being reflected in the markets, which struck me as, again, as you say, he's cautious anyway, but that seems to be a big statement from someone like Jamie Dimon. But as you say, that they're looking to invest. This AI train is ongoing, and I want to touch on that. I mean, obviously the banks I think this. I've got Bank of America report here. It says earnings season kicks off with 12% of index EPS this week alone, mostly financial, but 12%. That's we're going to get a fairly good picture at the end of this week, then I guess, of maybe not. You can tell me otherwise of where we're at in terms of the momentum and pace of Q3 numbers. I guess. I mean, we had Johnson and Johnson out as well today, which is a little bit more, I guess, in line with forecasts. But I just want to get on to something else you mentioned as well. And you say, although bank earnings jumpstart Q3, your team eyes 3 under the radar investor days. They say General Mills, Dollar Tree, and Salesforce events may shed light on the state of lower end consumer and corporate AI software trends. What do you mean by this? And should this be where everyone's looking? There should be more focus on this element of earnings.
Yeah, right. We kind of kick off the earnings season before the real kickoff with the banks. We do get some of those consumer staples names. We get Nike. So we start to get this little peek at the consumer that continues more towards the end of the season with the retailers. And certainly this bifurcated consumer is something that we've had our eye on, despite the, like you said, this AI trade being really strong and kind of carrying the markets and expected to carry the earnings season. We're starting to see consumer discretionary and consumer staples slip a little bit. They're two of the laggards this quarter, meaning that they're both expected to post year-over-year declines. I think S&P 500 consumer discretionary expecting earnings to be down 1.7%. Consumer staples a little worse off than that at negative 3.1%. So these are two areas that we're looking at for obvious reasons. The U.S. consumer has softened a bit more as of late. Now with the government shutdown, we're not even quite sure how much they're being impacted because we don't have the latest jobs data, but that's certainly one factor that determines consumer spending. If a consumer feels good about their employment and their ability to keep that employment or secure alternative employment if they do lose their job, then they'll continue to spend, right? And we certainly saw a healthy back to school shopping season. We're coming, Prime Day is always a record. So there's a resilient consumer out there, but we're starting to see the lower end consumer slip, and that you can see in some of the Dollar Tree results, and some of the other like lower end discounters. But by comparison, you have Walmart, really kind of taking the cake here. So they're both getting a lower to middle income consumer as well as capturing higher end in this environment. So again, it's this ongoing where they haven't quite slipped, but there's signs of cooling. We'll see what the holiday numbers look like, but it makes sense in this environment that folks would be kind of tightening up the purse strings a little bit, considering the inflation that has just been persistently high prices for so long, a worrying jobs picture. And so, I think people are certainly becoming a little more value driven, more bargain focused, which is why you see the discounters and the off-price retailers doing best in this environment. But certainly something that we're keeping an eye on as the overall picture.
Okay. Well, that leads me on to this, the government shutdown and such. And is the government shutdown likely to have any discernible impact on next quarter's figures if it drags on? I mean, we're into the second, I think we've done 2 weeks now, exactly 2 weeks of government shutdown. And looking back in history, I think the longest one in near history, it was like 30 odd days, I think, over Christmas, at the end of the year, a few years back. So can you see, I mean, it's very early, and should you expect to start seeing some of these corporate, some of the executives just start to worry or just put maybe a damper on Q4 numbers and maybe into 2026 on the back of this shutdown if we see it continue to play out, as in remain sort of shut for the time being?
Yeah, I think you could see on earnings calls this being addressed, brought up by analysts, because it does make forecasting for Q4 and beyond a little difficult. I mean, historically, government shutdowns have had a limited impact for the financial markets. Investors tend to be, more long-term focused, and these budget standoffs are typically short-lived. Even, You mentioned the longest one ever being 30 days. Well, that's relatively short. This time, we're still seeing, despite some other geopolitical issues that are going on, markets have not really reacted to the government standoff, but we have seen gold extend its bull run, crossing that $4,000 an ounce for the first time in history. And so is that investors retreating and kind of flocking to those safe haven assets? It's weird to have both stocks and gold at the levels that they've been, right? But generally for financial markets, you don't really see it reflected there. Where I do see it being an issue, like I said, for forecasting, for guidance, if it drags on, we're not getting a lot of these economic indicators that we rely on. So that will make it difficult for companies. That'll make it difficult for the Fed. They're not getting this official economic data that impacts their ability to, or they rely on it to make interest rate cuts, right? So sure. CPI, all the inflation indicators, the jobs numbers, we don't have that now. And so I think a lot of analysts had said we're probably safe for an October cut. But what happens if this extends beyond that October FOMC meeting? Right now, the CME FedWatch tool is looking still for the 2 cuts at the end of the year, October and December. But as this prolongs, if it prolongs, does the Fed say we don't have enough information to make a December cut, right? We don't have jobs data, we don't have inflation data. So sure. I see that being one of the potential issues. The second being, possibly weighing on GDP growth because of reduced government activity. JPMorgan noted that each week a shutdown subtracts about 0.1% of annualized GDP growth via reduced government activity. Okay. So we're, like you said, we've gone through a couple weeks now. And if that extends, what does that do to GDP? And then just lastly, on kind of jobs and the consumer, as we've touched on, the shutdown affects a small part of employees in the U.S., but it could be worse because of these threatened layoffs from the administration. And if that, results in actual job loss, that creates, more risks for the labor market and more of an impact on consumer spending. So again, usually there's back pay involved and you get your job back and you're paid retroactively. But the Trump administration has, threatened that potentially might not happen, or only some employees will get back pay. Some of those furloughs will go on to be permanent loss of job. And if that happens, you can certainly imagine the ways that reflects in the economy. So again, always looking for a swift end, but still no end in sight. So we'll see if they can, come to an agreement and
sure,
and end this.
Well, like you say, there's a bottleneck. So at some point, this stalled spending and investment does happen. But like you say, it starts to take off around the edges the longer this goes on. I want to get back into the earnings season as it is. Are buybacks doing the legwork for stocks at the moment? We're seeing obviously still record highs, despite everything that's been thrown at equity markets, particularly this year. We're still seeing it push on. And just part 2 of the question is that still mainly because of the Mag 7? Are they still the main impetus, the main driver of what we're seeing in this index move higher?
Yeah, so on the buybacks, it's funny, similar to kind of how I said, there's less M&A deals, but they're just bigger. Well, there's the buyback data that we collect actually shows there have been fewer total buybacks globally and in the US, but it's just the value and the dollar amount of those buybacks. We've surpassed 1 trillion. It's been a record year in 2025 for buybacks in the US, but it's very top heavy, very concentrated by many of those large tech companies that are just so rich in cash and continue to buy back, which is nothing new, right? I don't know, some people would argue it's the inferior way to return value to shareholders. You'd like to see more dividends, but the fact of the matter is over the last couple of decades, buybacks have eclipsed dividends as a mean of kind of rewarding shareholders. And it in this environment necessarily seem to make sense. You usually like to repurchase shares when you feel like you're getting a good value, but just by looking at PE levels, these are pretty richly priced. And so are they driving or doing the legwork for stocks, like you say? Well, they do increase share prices, right? It does reduce the supply, that increases the demand, so that often causes a price increase. But again, like I said, it's been such the trend over the last decade or two, but it has hit a fever pitch this year.
Yeah, it just in my head it kind of creates a false economy.
Yes.
As you've mentioned, for several reasons, and it's a worry. Obviously, Jamie Dimon mentioned it, and he thinks it's a little bit sort of toppy up here, and I guess it's one we'll have to wait for and watch. I just want to quickly sort of finish on the domestic versus the international at the moment, and just how mindful you and do you think corporate execs are of, we've had a resilient consumer household consumption from what we know so far up until the last bit of data that's been put out there of what we've seen of the economy from what we've seen so far with consumption data, despite still sticky inflation at the moment. The international picture at the moment, this renewed battle with China that we've seen President Trump reignite over the weekend, and then subsequently try and bring back a little bit since then. But how much damage does this do to confidence? Not in the US, not in the US per se, but just in terms of that investment, especially as we're seeing record highs in equity markets. Do you think at some point the corporate world starts thinking, well, we've got to start, just putting a bit back, just putting a bit more in reserve?
Yeah, it's funny. I think if you look at comments from someone like Jamie Dimon, like we said, he'd say, yes, he's worried about the geopolitical, I don't know if I'd call this tensions, but the dispute, the ongoing US-China trade dispute, like you said, what a whipsaw from Friday to, comments on Sunday that it will be, from President Trump that it would be fine, which markets really rejoiced yesterday. We saw the dollar rise yesterday. Traders are shrugging off some of the threat of tariffs, and instead they kind of focus on a path forward because, look, I mean, I saw, is this reigniting the taco trade? The Trump always chickens out, right? Like, and just historically, how have these two nations, it's always ends up with some sort of tactical truce, right? And so if you look historically, we always come to at least a pause or a negotiation of sorts. But again, as you're saying today, the story's completely changed, turned on its head again. It's, China imposed sanctions on 5 South Korean Hanwha Ocean subsidiaries, U.S. subsidiaries. And so that would forbid organizations in China from doing business from those affected companies. And it's, meant to support China's security, but we're seeing, let's see, the last I looked, Dow was down quite a bit on that news. And again, it throws the conversation back in the other direction. And so we'll wait to hear. Some in the Trump administration had some pretty strong comments about that. And it's okay, again, when will they come to a conclusion on this, or yet another truce, which I believe they will. But, it's throwing everything off kilter. The VIX, I think, is up to 22. It's a 4-month high. So it's funny, there's still so much uncertainty out there. And that's why there's always these, emerging questions about, is this a bubble that we're seeing? You mentioned AI before, and obviously this is like the next industrial revolution. This is the next great tech leg up. But given the underpinnings of the economy and the uncertainty, the trade policy, we rely on China for a lot of what we need for AI to be successful. And so it's all an ecosystem that has to be in balance. And these market swings, although seemingly good for banks and trading desks, like you said, it impacts investor psyche, and it makes you wonder if investors, if companies themselves will start to pump the brakes a little bit, because
Mm,
the there's a lot of things making the picture very murky right now. One, the government shutdown. We don't have accurate data. We don't have current data. And then uncertainty about how tariff inflation really stacks up, which we've heard from some CEOs. They don't believe it's fully filtered through yet. And then, on the back end, you've got this issue we've talked about with the consumer cooling a little bit. So, yeah, at some point, the uncertainty stacks up. I think the fervor behind AI is absolutely warranted. But, we talked a little bit about how top heavy it is.
yeah.
Just to give
Well,
you
it's here to stay. I mean, that's just
here to
that's
stay, yes,
yeah.
no
It's
doubt.
not absolutely. It's how it's utilized to its maximum. We've yet to know, because there's still a lot to learn. And like you say, it is like another industrial revolution. That's the word. And people were suspicious of that. People said you'll never get rid of the horses until these iron sort of steam machines came along in the form of trains or whatever. So yes, I mean, I think there is a lot of development still to be done with AI, and its use cases still to be completely figured out. But yeah, that's not a bubble, and but it like you say, is potentially just masking some of the underlying issues that there are in the markets that fundamentally would have made people a little bit more cautious than we're seeing at the moment about wanting to pump more in, as shall we say. So yeah, I'm a little bit worried about that. But again, just bringing it back to as we close off this earnings season then. So we've seen a good start so far with the banks. We've got, if I look at the Wall Street Horizon Q3 earnings season preview, which we'll put up first 3 weeks. So 15th tomorrow, we have the likes of ASML, which is going to be timely, like you say, on the tech front as well as the likes of other banks, Bank of America, Morgan Stanley, set to report. It'd be interesting to see just quickly on the drug company front, with everything that Donald Trump's trying to do there, how they try and I think calculate numbers moving forward with what they have to do. Have you seen any particular worries on that front from the big drug pharma firms as yet?
It's interesting. If you look at just overall sector level, healthcare earnings per share, they're one of the laggards. They're expected to see EPS decline year over year by a tune of about negative 1.7%. Yet revenues are still quite healthy at 8%. So revenues are outpacing overall S&P 500. So that's kind of a interesting dichotomy there that we'll be listening as more of these pharma companies come out. I think more of them are out next week, along with some of the big tech names. But so that's certainly a sector to watch, because they are a laggard on the bottom line, but seemingly still healthy on the top line.
Okay, interesting. All right, listen, Christine, thank you very much for your input today. Again, this is just interesting times at the moment, generally for those both looking at the markets and trading them. So thank you very much for your insight. We'll put up all the contact details so people can have a look a bit more into Wall Street Horizon and how much of an attribute it can be for your investing. Hopefully, we'll get you on again, hopefully mid-season, if not ahead of Q4, to sort of assess where we're at.
Thank you so much for having me. And yeah, it shouldn't be a boring earnings season. I think this is going to be one of the more interesting ones. So we'll, like you said, we'll check in when we get halfway and see where things have landed.
Perfect. Excellent. If you missed the start of today's episode, you can listen back on X or YouTube, or find us on podcast platforms such as Spotify, Amazon Music, as well as other places. Thanks again for listening, and we hope to see you soon. Thanks for tuning into the Large Corp Podcast. Your edge in the market starts here. Subscribe now.